Hello everyone, welcome to BISP Solutions. So our today's topic is we will be seeing Accounting Standard Codification 310 and 350. So Accounting Standard Codification 310 stands for Accounts Receivable and Accounting Standard Codification 350 stands for Intangibles. So we'll start with Accounting Standard Codification Accounts Receivable, that is 310. So it's a financial accounting standard board standard that provides accounting guidance for receivables. It covers general guidance, non-refundable fees and other costs, loan and debt securities acquired with the deteriorated credit quality, and troubled debt restructurings. The goal of this topic is to ensure proper accounting for loans, credit sales, and other forms of receivables, including disclosures about credit quality and allowances for credit losses. There are some key aspects of Accounting Standard Codification 310. First, we'll see about receivables. Overall, this 31010, this subtopic provides general rules for recognizing. Okay, so here we'll start with, I'll keep on including 31010, which stands for, it tells us overall. So this subtopic provides general rules for recognizing and measuring receivables, including guidance on standby commitments, factoring arrangements, and rebates. Then second is Accounting Standard Codification 31020, which stands for non-refundable fees and other costs. So this section addresses the accounting for non-refundable fees, origination cost, and acquisition cost which is associated with the lending activities and loan purchases. Third, we'll deal with Accounting Standard Codification 310-30. Loan and debt securities acquired with deteriorated credit qualities. Loan and debt securities acquired with deteriorated credit quality. So this subtopic guides entities on how to account for loans and debt securities at the time of acquisition, and it shows evidence of credit quality and deterioration since their original issuance. And then we have one more, that is 310-40, which stands for debt restructuring. Debt restructuring. So this section focuses on the creditor's accounting when a loan is restructured under the terms that provide relief to a debtor experiencing financial difficulties. So basically, Accounting Standard Codification 310 aims to standardize how companies report financial instruments that represent future inflows of cash, ensuring that the financial statements accurately reflect a company's financial position and performance related to its lending and credit activities. Okay, so here we'll also study one topic, factor that we'll cover later on. So let's get started. Accounts receivable. It's an oral promise to pay the debt. Generally, it is classified as a current asset on balance sheet. These are classified either as trade or non-trade receivables. The net realizable value of account receivable is calculated as gross value of the receivable adjusted for any uncollectible sales returns or sales discounts. So we adjust all of them. So here you see, either you show it in base format or in T format. In T format, you have debit column and credit column. Then we have a beginning balance of accounts receivable as 1 lakh. We have done the credit sales of 1,50,000. So again, your accounts receivable gets increased by 1,50,000. Accounts receivable written off was 5,000. That is bad debt written off, you can say. Then we collected 20,000 from the accounts receivable, so it gets reduced, so that's why it's coming on the credit side. If accounts receivable are increasing, that will come on the debit, and if it is decreasing, it will come on the credit side. So write off of 5,000 on the credit. If you have collected 20,000, that means account receivable are decreasing again because we have collected 20,000 from them, so minus 20,000, and it is converted to NR, so it is being converted to NR to some different thing. So again, account receivable will reduce by 1,000. So 1 lakh plus 1,50,000 minus 5,000 minus 20 minus 1,000. So it will be 1 lakh plus 1,50,000 minus 5,000 minus 20,000 minus 1,000. So it should amount to 2,24,000, which is only the ending balance of accounts receivable. And on the right side, if you see, this is your base format. You can show in the different way as like this also. So beginning balance of accounts receivable is 1 lakh that you were showing on the debit and credit column. That was a T format, and this is a you can say vertical format. Then we'll add, if you've done the credit sale, account receivable gets increased, so the balance will be 2,50,000. Okay, then we'll subtract what is if the cash has been collected. So 20,000 have been collected. This has been written off as a bad debt, and this is convertible to NR, means notes receivable. So it is no more accounts receivable, it is a notes receivable. So these all will be reduced. That's a sum total of 26,000. So 2,50,000 minus 26, it will be 2,24,000. End balance will remain the same, that is the ending balance. Only a presentation point of view, there are two different methods that you can show. Now, if accounts receivable received with discount, so there are two types of discounts. If there are two types of discount, one it is speed discounts, second is it is quantity discount. Okay, so if you talk about speed discount, the sale and cash discounts, you have promotional activity where you sell products, services on credit to creditors, and you pay within a certain period, then you are eligible for discount. And if you pay within when the entire period is over, then you are not eligible for discount. So when you have promotional event to increase your sales, then to account that particular discount, you have a gross method and a net method. So two methods are covered. You can bifurcate it on the basis of gross method, and the second is the net method. So gross method is the method that it considered the sale without considering available discount. It goes with assumption that customer will not make use of discount. And net method is the method if you sell a customer, if you feel customer will make use of sales discount, but actually the customer did not make payment within the time frame to be eligible for the discount. So customer makes payment late, so then it will follow the net method. Second, quantity discount. These are trade discounts. These are quoted in percentages and are applied sequentially. We don't add the multiple discount. We apply them sequentially. For example, to discuss this gross and net, there's one example. Suppose Orange Company sells 1,000 worth of goods to the Red Company. The terms of sale are 2/10 and N30. That means if the sale happens within 10 days, then 2% discount will be, then the person will be eligible for 2% discount. If they are paying more than if they are taking more than 10 days, that means there will be no discount available for them. So journal entry at the end of the sale will be, if it's a gross, that means no discount, and if it's a net, that means a discount will be available. So at the end of sale, we'll pass an entry accounts receivable account debit to cash account credit with the amount that 1,000 goods were sold, so 1,000, and here net means 1,000, and we are assuming that 2% discount is available to them, so 1,000 minus 20, it's 980. So this is the sale amount. If not received within 2/10, That means if not paid, if not received we have not paid the money within 10 days, so there will be no discount. So cash account debit 1000 and accounts receivable account credit will be there because we have received the money, so 1000 and receivables will be reduced, so 1000 and sales discount there will be nothing. And in the net concept, 1000 will be received, 980 will be accounts receivable, 20 will be the sales discount if it's a net. Then if payment received within 2/10, so cash account debit, here it will be, now here also in gross also it will include the discount. Cash account debit is, will receive 980, sales discount has been taken off 20 and accounts receivable is of 1000. Here also under net 980 and 980. So this is the concept, like here it is always net, in net always it is taking the discount percentage, in gross it is not taking. If they have made payment is received within 10 days, then only the gross then only discount will be taken off in the gross method. Okay. Now we have another two methods. First is a direct write-off method. In direct write-off method, it is a non-GAAP. It is useful for tax purpose. So when you sell on credit, you debit your account receivable. You have a prediction. What if creditor defaults? Then I have a bad debt expense account which will be debited. In this method, bad debts expense are not accounted for. You might accrue for revenue in year 1 but may not record it until the write-off. So this method is used for federal income tax purposes. So without making provision, company passes journal entry for bad debt expenses. We'll see one example of direct write-off. So now assume, suppose on December 20, Pink Company recorded a credit sale of $5,000. $5,000. And now on August 15, that is in year, this was in year 6th and this is in year 7, the company determined that accounts receivable was uncollected. Accounts receivable was uncollected. Then in that case, what JE will be recorded? So JE will be recorded, to record the uncollectible will be, it will assume that this is my bad debt expense because this is uncollectible amount that will not collected. So bad debt expense will be booked and we will say to accounts receivable will be reduced. So account receivable account credit with the amount 5,000. Okay, because we are booking the bad debt expense and we are debiting it and crediting the account receivable. Then second method of it is allowance method. Suppose in allowance method, this is a direct write-off method, first method. In second method, it is allowance method. In this allowance method, now Green Limited estimates that uncollectible amount on total credit sales for the period. The Green Limited estimates that 5% of its 5 lakh sales on credit will not be collected. Now Green Limited estimates that 5% of its 5 lakh sales on credit will not be collected. The credit balance in the allowance for uncollectible accounts before adjustment is 5,000. So the balance before uncollectible is 5,000. Okay, so now what we'll be doing in this case, we'll say we have done a credit sales of Suppose we have done a credit sales of, here it is saying 5% of its 5 lakh sales on credit. So 5 lakh is the credit sale. Then we are saying estimated uncollectible amount is because it says Green Limited estimates that 5% of 5 lakh sales on credit will not be collected. So 5% of 5 lakh will be, on this it will be 0.05. 25,000 will be uncollectible amount. So this is estimated uncollectible amount. Now beginning balance in allowance for uncollected amount is, now we have said this is the beginning balance of the uncollected amount. So beginning balance, initially we have assumed that the balance will be 5,000, of which this amount will not be collected in the future. Now we have to increase it by allowance to be increased by 25,000, because suppose in the last year we assume 5,000 will not be collected. In this year now we are estimating 25,000 will not be received. So allowance to be increased by increased by 25,000. So in total we have a 30,000 ending balance. So this 30,000 is the ending balance for ending balance of the allowance for uncollectible amounts. So we'll mark this 30,000 and we'll pass the journal entry as, we'll book it as a bad debt expense, bad debt expense account debit. So now this bad debt expense 5,000 might be booked initially. You can see this 5,000. It might have been booked initially also. So we'll not repeat it. Now we'll book it an allowance for bad debt. Instead of accounts receivable, instead of crediting accounts receivable account, here we are crediting allowance for uncollectible amounts. Allowance for uncollectible accounts, and this is also 25,000. Okay, so this is how you will be doing the different methods, allowance method and direct write-off. In this way you will be writing off your bad debt expense. Now let's see what is factor. Now we have some other receivable concepts as well, that is factoring. So factoring is a process whereby a company converts its receivables into cash by assigning them to another person or a company, which is known as factor. The factoring arrangements can be with or without recourse. The second topic that we will be covering in other receivable is notes receivable. Now notes receivable is the written promises to pay the debt, called as promissory note. Here you enter a current asset or a non-current asset depending on when the collection will occur. If the non-current asset, then for financial statement purpose, the present value of the note it is required, that is face amount minus unearned interest or the finance charges, if any. Okay, let's see what is factoring. So factoring is a type of financing agreement where a creditor buys the right to or the credit risk of a company's accounts receivable. Instead of getting a loan from a bank, a company may sell their accounts receivable to a creditor for fee, instead to shore up immediately cash or improve their balance sheets. So a factor is a funding source. It agrees to pay a company the value of the invoice less a discount for commission and fees. The terms and conditions set by a factor may vary depending on its internal practices. Now, what are the requirements for a factor? Although the terms and conditions set by a factor can vary depending on its internal practices, the funds are often released to the seller of the receivable within 24 hours. In return for paying the company cash for its accounts receivable, the factor earns a fee. The company selling the receivable transfers the risk of default by its customer to the factor. As a result, the factor must charge a fee to help compensate for that risk. Typically, a percentage of the receivable amount is kept by the factor. However, that percentage can vary depending on the creditworthiness of the customers paying the receivables. So if the financial company if the financial company is acting as a factor, it believes that there is an increased risk of incurring a loss due to the customers not being able to pay the receivable amounts. They'll charge a higher fee to the company selling the receivables. If there is a low risk from collecting the receivables, the factoring fee charged to the company will be lower. It's a direct proportional case. Okay, so this was our accounting standard codification 310, that is accounts receivable. Now we'll see intangibles. Now intangible includes goodwill. So it can be goodwill, evaluation of goodwill, intangibles, impairment of goodwills. So all those things will come into the accounting standard codification 350. So this standard provides a guidance on intangible assets, including the initial recognition, subsequent accounting, and impairment testing for assets such as goodwill and other indefinite intangible like trademarks. So companies must regularly assess their assets, and if the assets carrying value exceeds its fair value, so carrying value, if it is more than its fair value, they must recognize an impairment loss. There are some key aspects of accounting standard codification 350. First, it is intangible asset. So this standard covers both goodwill and other intangible assets that lack physical substance such as patents, trademarks, and customer relationships. Second is goodwill. So accounting standard codification 350 specifically addresses the accounting for goodwill which arises from business acquisition and represents the excess of the purchase price over the fair value of identifiable net assets acquired. Here we will also do the impairment testing. Now impairment testing means company must periodically test the goodwill and other indefinite lived intangible assets for impairment. So an impairment occurs if the assets carrying amount on the balance sheet it is greater than the fair value. The testing process typically involves both a qualitative assessment to identify events that could trigger your impairment and a quantitative test to measure the loss if an impairment is indicated. So if you talk about in US GAAP, you have, if you see, if there are infinite life or indefinite life for the intangibles. So features is it have a limited useful life, that is it's a finite life, and life cannot be determined. And if you talk about there are some of the features. If you have indefinite life, so life cannot be determined. Finite life means there's a limited useful life. If you do the amortization, so amortization will be done over useful economic life, and there is no amortization if the asset has an indefinite life. Impairment test. So here if it is a finite life, that means undiscounted net cash flows, and it will be impairment test will be done on the basis of fair value. And if it is asset has an indefinite life, that means impairment test will be done on the basis of fair value only. Now finite life and indefinite life, there's a difference. So if you do the impairment test, if it's an impairment test, so impairment test will be done if there is an undiscounted future net cash flows, that is net carrying value. Here it is required. If it's a finite life, that means it is a positive and there will be no impairment loss. And indefinite life, that means it will have a negative impairment. And indefinite life, life here will be calculating fair value, net carrying value. So that will give you a requirement, that will give you a calculation of your impairment loss. Okay, let's see example quickly. Okay, gold company has two reporting units named silver and bronze. As per the company's policy, gold company annually evaluated for goodwill impairment and determined that the fair values of the silver and bronze at 31st December are as follows. Now there are two reporting units, silver and bronze. Booking value is 4 lakh and 5,50,000 respectively. Goodwill reported it is 75,000, 80,000, and implied fair value is this much. Now we'll do the calculation. So we'll see that reporting units of silver and bronze. So if we talk about silver, it will be negative 50,000. That is possibly impaired. And if we talk about bronze, it will be 1 lakh. So silver impairment loss will be it will be goodwill implied fair value. So goodwill, which is accordingly implied by its fair value, it will be negative 50,000. You see here the book value and the fair value. We are doing the comparison. So silver's book value and the implied fair value, the difference of it will be 50,000. That is only 50,000. And here it is 550 and 650. That is 1 lakh. So bronze reporting unit will be this. So goodwill implied fair value for the bronze, it will be 1 lakh. Okay, now we are calculating the silver's impairment loss only. So goodwill implied fair value is negative 50,000, and goodwill implied not fair value, it is goodwill implied book value, it will be 75,000. You see, this is your book value, and the difference between these two will be 50,000. So in short, it will have negative, it will have 25,000 balance, 75,000 minus 50,000. And similarly, so now you can do it similarly for the bronze as well. And here what you will do, we will say book the entry as loss due to impairment. Now the loss due to impairment, it is 25,000, and goodwill account will be credited because this is a loss that we have booked it. So goodwill account credited with 25,000. Okay, so this is how you do, and now you can similarly do it for bronze as well. So under bronze, what you will do, goodwill implied fair value and book value, you can take it as, instead of 50,000, here you can take it as 1 lakh, and goodwill implied book value will be 80,000. So difference between these two will be 20,000, and the loss due to impairment will be 20,000, and the goodwill amount will be booked as 20,000. So this is how you will do the calculation as per the goodwill. And goodwill is nothing but, if you have suppose you have purchased the fixed asset, suppose I am buying a fixed asset whose value is not identifiable, right? Suppose I am purchasing the fixed asset from some company, suppose from Top and Down. I am purchasing its inventories. So its inventories costing is 5 lakh. But if you do the valuation, its market price, it's suppose 4,50,000. Then why am this Top and Down is charging more from the market value? So because it has a goodwill, because it has earned a goodwill of 50,000, it's charging its goodwill amount of 50,000, and we are paying it the goodwill value of 50,000. So in short, we are paying because we are getting it from the Top and Down. So that's your goodwill, and this is not this is not a physical asset. It's just a value or the image that you have owned in a number of years. So that's a goodwill. So you do the impairment of your goodwill. Okay, so impairment of an intangibles can be done, and you compare it with the market value. So why it has increased or not. So you charge it, what's the price of it, what's the book value, how much you have reported it, what was the fair value, that is your market value. In books, how you have recorded it. So you find out the difference and report it over here. Okay, so yeah, so this standard covers this thing only, that is goodwill and the impairment of goodwill. That you see in intangibles, we covered the goodwill portion, and there will be other intangibles as well that you can cover. So similar concept will be followed for all the intangibles. You can do the impairment testing. So the company must periodically test goodwill and other indefinite intangible assets for impairment. So impairment will only happen if the assets carrying amount on the balance sheet is greater than its fair value, and the testing process typically involves both a qualitative assessment to identify that the events could trigger the impairment, and quantitative tests to measure the loss if an impairment is indicated. And amortization means unlike finite lived asset, which are amortized over their useful lives, indefinite lived intangibles including goodwill are not amortized, because if an asset's useful life is determined to be no longer indefinite, it will be tested under impairment guidance for finite lived assets, and then it will be amortized. Okay, so yeah, that's all for today. We covered the two accounting standard codification, 310 and 350. So if you have any questions, please contact BISP Solutions. Thank you all for your time. Thank you.